Don't worry, mortgage rates are coming down. I know you've heard this because it's all over. Your question is, when are they coming down? How much are they coming down? In this video, I'm going to show you what I think is the most accurate forecast I've seen for what mortgage rates are going to do for the rest of 2023, and then in 2024, 25, 26, all the way to 2027. Stay tuned. I'm going to walk you through it, tell you where it came from, and show you their reasoning behind it. All right, Matt the Mortgage Guy, residential mortgage broker, licensed in 48 states. Before I get into mortgage rates and what they're going to do over the next 4 years, I just want to tell you, me and my team are more than happy to help. You need somebody in your corner who lives, eats, breathes this stuff every single day. Go to greatmortgagebroker.com, connect with my team nationwide. Okay, let's jump into mortgage rates because that's the million-dollar question. And while it's not going to solve everything for all people, and truth be told, if rates went down too fast, too much, it would cause more problems in the housing market than it would solve affordability. Mortgage rates inevitably are going to come down for a number of reasons. The biggest one, in my opinion, is the fact that inflation is coming down. All this upward pressure on mortgage rates from the Fed, jacking up the Fed funds rate, is going to reverse once the Fed sees continued inflation numbers coming down. Here in July 2023, we just got more PCE readings, more inflation readings that show core inflation is down. It beat expectation. It went lower than we thought. Headline inflation is down. And so no doubt mortgage rates will go down. I'll show you the visual because I think it's helpful. And we're not only going to look at the 30-year mortgage until 2027, we will look at the 10-year treasury, the Fed funds rate. I'll tell you how they influence each other. You might not be able to read this because it's kind of small, but this top line, the yellow line, is 30-year fixed rate mortgage rate. And it's an average, right? The blue line, that, as you can see, like they follow in lockstep, that's the Fed funds rate. And then finally, this pinkish line is the 10-year treasury. The reason this 10-year treasury one is important, one, you can, generally speaking, have an idea of where 30-year mortgage rates are by looking at the 10-year treasury. But currently, and I guess I'll just dive into this right away. Currently, this dark line right here, this is 2023. This 10-year treasury, and this one might have been a couple months ago because it's actually up here, right? The 10-year treasury is about 396 as of today, but the spread between the 30-year fixed rate mortgage and the 10-year treasury is about 3 full percent. Fancy financial people would call that 300 basis points. The reason why there's such a large spread is because there's a lot of volatility. Things are moving, things are shaking, there's uncertainty. And so that spread is larger than it normally is. That spread, if you look at it over the last 3-4 decades, is almost always 1.8 to 2%. I mean, look at how close these lines were back in 21. We had a 3% mortgage rate and a 1.4 10-year treasury. So we're only talking 160 basis points, 1.6. Here it's closer to 2%. Here, that looks like about 1.8, 1.9. Here, another 1.6-ish, 1.6-ish there. And so 1.8 to 2% is the normal band between the 10-year treasury and the 30-year fixed rate mortgage. It's 3% now. As volatility comes out of the market, there's less uncertainty and we get into a stabler economic environment. I can't do it with my fingers here, but between the 30-year fixed rate mortgage and the 10-year treasury, you're going to see them start to come back together. And that's one of a few reasons why 30-year fixed rate mortgage is going to go down. They're also going to go down because the Fed, once they see inflation is under control, a lot of us think they're going to overshoot their target. They want to get inflation down to 2%. The inflation readings that came with the same report show inflation in 24, 25, and 26 under 2%. The Fed is going to overshoot. So they're going to be more than justified in cutting the Fed funds rate. If they cut it, down to 4.25 in 2024, and then there's all this data showing inflation's at 1.6, 1.7. Oh my gosh, we overshot it. We can cut the federal funds rate. And when they do that, when they go from 4.25 down to 2.25 in 2025, that would be 8 quarter basis point rate hikes, or 450s, or however they wanted to slice it. That is going to cause mortgage interest rates to come down. They're not necessarily, when the Fed funds rate moves, the mortgage rate doesn't follow in lockstep, but it rhymes, right? You can see this, and you can see it over a longer time horizon. And so inflation's coming down. The Fed funds rate is coming down. Volatility is coming down. All this stuff is why we're looking at 5.25 in 2024, 4.5 in 2025, 4.25 in 26 and 27. Every day, not every day, every other day, I've got people that I talk to that tell me, when am I going to be able to get 3.25 interest rate again? As you saw on this chart, 4.25 was the bottom of where mortgage interest rates would go. And I think that's even, pretty optimistic. If rates make it under 5% by 2025, I think that will be, if it's slow enough and we've got enough inventory coming to market, we'll be okay. It won't hurt the housing market, but we don't want it coming too fast, and we certainly don't want it going too low, as much as that's counter to what most people think. There's a problem with affordability. Let's solve it. Let's have interest rates go to 4%. Then more people can afford. Well, more people can afford, but there's going to be not enough houses for them to buy. And so they're all going to compete, and they're going to push up on home prices. Home prices are going to go up 10, 15, 20%. We don't want that, right? And there is the argument about rates go down to 4%. It's going to unlock some supply because some people will sell and they'll move up, all that stuff, right? But this is a realistic picture. And I think they did a really good job. I'll put links down below to this article done by, I think it was in Morningstar, but anyways, I'll have the link below. Good job of painting the full picture. 10-year treasury, Fed funds rate, 30-year fixed rate mortgage. It's not some wackadoo rates will be 3.5% by next year, because it's just not going to happen. People that hope for that, I had somebody ask me yesterday, they had a rate on an investment property they owned that was 3.25% on an investment property. And this 30-year average here is owner occupied. Investment properties are even higher. When is it going to get back to 3.25? And I told them maybe never. And I truly believe that. If owner occ stuff gets to 4.25 here, investment property stuff will be 5.25, still 2% off. And I think this is optimistic, right? And so it would have to be something relatively catastrophic in the economy that would cause the amount of easing Fed cuts to pull interest rates down to the levels we saw in 2020 and 2021. It's likely going to be a once in a lifetime event for those of us who saw it. Those of us who were fortunate enough to refinance multiple properties or buy properties during those times to, able to slap those low interest rates on. So hopefully it's helpful. Let me know your thoughts. Let me know down below your predictions, what you think interest rates are going to do in 24, 25, and beyond. I'd love to hear from you. Hopefully this was helpful. Have a great day. And honestly, until next time, we gonna see.